Most people pick a stock the same way they pick a lottery number. They hear a name on the news, or their cousin mentions it at dinner, or they see it trending online and they buy it. No research, no questions, just a feeling. And then they sit there every day, refreshing the price, hoping the feeling was right. Here's the problem with that. Hope is not a strategy. Hope has never made anyone wealthy. And yet this is how most people in America and Europe are handling their hard-earned money right now, today, while you're listening to this. Now imagine a different person. This person buys a company almost nobody is talking about. He holds it. He doesn't sell when it dips. He doesn't sell when his neighbor brags about some other stock that doubled overnight. He just waits, quietly, for years, sometimes for decades. And one stock he bought turned into a gain of over 20 times his money. Not 20%, 20 times. That's the difference between investing $50,000 and ending up with $1 million. The man behind that story is named Philip Fisher. You may not know his name, but you almost certainly know his most famous student. Warren Buffett, the richest investor alive, has said again and again that Fisher shaped how he thinks about money. Buffett didn't just read Fisher's book once. He studied it. So today, we are going to break down Fisher's book, Common Stocks and Uncommon Profits, in the simplest way possible. No jargon, no Wall Street language. Just plain ideas that any person, whether you have $10,000 or $10, can actually use. Because here's the truth. Most people think investing is complicated on purpose. It's not. It's been made to look complicated so you feel like you need someone else to do it for you. Fisher believed the opposite. He believed that an ordinary patient person who asks the right questions can outperform almost every professional on Wall Street. By the end of this video, you will understand exactly what those questions are. Let's get into it. Section 1. Why most people lose money without realizing it. Let's start with the biggest mistake Fisher noticed people making. And you've probably done this yourself without even noticing. Most people buy a stock because of the price. They think, wait, this stock is cheap, so it's a good deal. It feels exactly like shopping. A discount feels good. A markdown feels smart. But a stock is not a pair of shoes. A cheap stock can be cheap for a reason. Because the company is dying. And an expensive stock can still be a bargain. Because the company is about to grow far beyond what people expect. Fisher's first big idea is this. You are not buying a price. You are buying a piece of a business. That's it. That single shift in thinking is the difference between gambling and investing. Think of it like buying a house. You wouldn't buy a house just because the price dropped. You'd want to know, is the roof solid? Is the neighborhood growing or falling apart? Is there a reason it's cheap that should worry you? A stock works exactly the same way. The price tag tells you almost nothing on its own. Section 2. The 15 questions, simplified. Now here is where Fisher becomes genuinely useful. He created a list of questions, 15 of them, that you should ask about any company before you put your money into it. We're not going to read all 15 word for word. We're going to simplify them into ideas your brain can actually hold on to. Question 1. Is this company going to keep growing for years, not just this year? A lot of companies have one good product, one good year, one lucky break. Fisher wasn't interested in that. He wanted to know if the company had room to grow for 5, 10, 15 years into the future. Think of a small coffee shop that's great versus a coffee chain with a plan to open in every city in the country. One has a ceiling, the other doesn't. Question 2. Does management actually want to keep growing, even after they've already made their money? This one surprises people. Some company leaders get rich, get comfortable, and stop pushing. Fisher wanted leaders who were still hungry even after success. Imagine 2 athletes. One trains hard until he wins the championship and then relaxes forever. The other wins the championship and immediately starts training for the next one. You want your money inside the second athlete's team. Question 3. How much does the company spend on research, and is that money actually producing results? A company that never tries to improve its product is a company standing still while the world moves forward. But spending money on research isn't enough either. It has to actually lead somewhere. Spending without results is like a student who studies 10 hours a day, but somehow still fails the test. Something is broken in the process. Question 4. Does the company have a sales team and a sales system that actually works better than its competitors? You can build the best product in the world. If nobody knows it exists, it doesn't matter. Fisher cared deeply about whether a company could actually get its product into people's hands. Question 5. Does the company make good profit on what it sells? And not just from one good year, but consistently? This is simple. A business has to actually make money, not might make money one day. Real, repeatable profit. Question 6. Is the company doing what it can to protect and grow that profit margin over time? Profit today means nothing if competitors can copy the idea next year and crush the price. Fisher wanted businesses that had some kind of edge that couldn't be easily copied. A brand, a patent, a reputation, a relationship with customers that took years to build. Question 7. Are the people working there happy, or is everyone trying to leave? This one feels almost too simple, but it matters enormously. A company where good employees stay for decades is usually a company being run well. A company that's constantly losing its best people is bleeding from a wound that doesn't show up on a financial report until it's too late. Question 8. Do the people at the top treat employees fairly? Same idea, different angle. Fisher believed you could often predict how a company would treat its customers and shareholders by how it treated the people who worked there every single day. Question 9. Is there a strong team underneath the CEO? Or does the whole company collapse if one person leaves? If a company is one person away from chaos, that is not a stable place for your money. You want a company that would survive even if its star leader got hit by a bus tomorrow. Harsh example, true point. Question 10. Does the company manage its costs and its numbers carefully? Good businesses know exactly where their money goes. Sloppy businesses guess. You can imagine the difference between someone who tracks every dollar of their budget versus someone who just hopes there's enough left at the end of the month. Question 11. Does this company have something that makes it different from competitors? Something hard to copy? This is what people today often call a moat. Fisher was talking about this decades before that word became popular. It might be a brand people trust blindly, like a soft drink everyone recognizes by its bottle shape alone. It might be a relationship with customers that took years to earn. Whatever it is, it needs to be something a competitor can't just copy overnight. Question 12. Is the company thinking long-term or just trying to look good this quarter? Some companies make decisions purely to make this year's numbers look impressive, even if it damages the next 5 years. Fisher wanted businesses thinking in years and decades, not in 3-month chunks. Question 13. Will the company need to keep asking investors for more money in ways that shrink your share of ownership? If a company constantly needs to raise new money by selling more shares, your existing piece of the pie keeps getting smaller and smaller, even if the business is growing. You want a company that can fund its own growth instead of constantly going back to investors with a handout. Question 14. Does management talk to investors honestly, especially when things go wrong? Anyone can sound confident when business is booming. Fisher wanted to see how leadership communicated during the hard times. Do they explain problems honestly, or do they disappear and dodge the bad news? This single trait reveals more about a leader's character than almost anything else. Question 15. Is management's integrity beyond question? This is the final and, in many ways, the most important point. Fisher believed that even the smartest business strategy in the world is worthless if it's run by people you can't trust. A brilliant company run by dishonest people is not an investment. It's a trap waiting to spring. If you remember nothing else from this video, remember this. Fisher was not looking for a cheap stock. He was looking for a great business, run by great people, that the rest of the market hadn't fully noticed yet. Section 3. The don'ts. What to avoid now. Fisher didn't just tell people what to look for. He also gave a list of things to avoid. And honestly, these don'ts might save you more money than the do's will ever earn you. Don't buy a company just because it's a new exciting startup with no track record. It's tempting. New companies feel exciting, like the beginning of a movie. But excitement is not evidence. Most new companies fail. and you have almost no history to judge whether this one is different. Don't ignore a great company just because it feels too expensive on paper. Remember the house example. A stock that looks expensive today might be a steal once you realize how much that company will be worth in 10 years. Cheap is a feeling, value is a fact. Don't buy a stock purely because you like the company's annual report or its marketing. A beautifully written report is not the same as a beautifully run business. Companies hire people specifically to make reports sound impressive. Don't fall for good writing. Look for good numbers and good behavior. Don't assume that because a stock went up a lot, it's now too risky to buy more, or that because it dropped a lot, it must be cheap and safe to buy. Price movement by itself tells you nothing about whether a business is healthy. Many people make the mistake of treating a falling stock price like a sale at a store. Sometimes a stock falls because the business itself is breaking down underneath it. Don't follow the crowd. If everyone around you is buying the same stock at the same time out of excitement, that excitement is usually a warning sign, not a green light. Fisher believed real opportunity is usually quiet. Sitting in a company most people haven't noticed yet, not in the company everyone is shouting about today. Don't spread your money across 50 different stocks just to feel safe. This might surprise you, because most advice today tells you to diversify endlessly. Fisher disagreed. He believed that owning too many stocks means you can't possibly understand any of them deeply. He preferred owning a smaller number of truly excellent businesses that you understand completely, rather than a giant pile of average ones you barely know anything about. Imagine trying to be close friends with 100 people at once. You can't. You'll know all of them a little and none of them well. Investing works the same way. Section 4. The power of patience. Conservative investors sleep well. Here is something Fisher believed deeply, and it goes against how most people behave with their money. Real wealth is boring to build. Most people want the thrill. They want the stock that doubles in a month. They want the story they can tell at dinner. But Fisher's entire philosophy is built on patience, buying into a great business and then doing almost nothing for years. Think about a tree. You don't plant a seed and dig it up every week to check if it's grown. You'd kill it. You plant it, you water it occasionally, and then you simply let time do what time does. Money grows the exact same way. The investors who keep digging up their seeds, checking the price every hour, panic selling at every dip, are the ones who end up with nothing to show after years of effort. Fisher called this idea conservative investing. Not boring as in doing nothing useful, boring as in calm, careful, and unbothered by daily noise. The conservative investor sleeps well at night because they didn't put their money into something they don't understand, chasing something they can't control. Section 5. When to actually sell people. Assume Fisher's advice was simply buy and never sell. That's not quite true. He gave very specific reasons for when selling actually makes sense. Reason 1. You made a mistake. If you misjudge the company, the leadership wasn't what you thought, or the business isn't growing the way you believed, admit it and move on. Fisher respected honesty about mistakes far more than stubborn pride. Reason 2. The company has changed for the worse. Maybe new leadership came in and the culture shifted. Maybe the thing that made the business special got copied by everyone else. If the reasons you bought the stock no longer exist, there's no reason to keep holding it out of loyalty. Reason 3. You found something even better. Sometimes the smartest move isn't holding what you have. It's moving your money into an even stronger opportunity that you found through the same careful research. But notice what is not on that list. The stock went down is not a reason to sell. I'm a little nervous today is not a reason to sell. Everyone online is panicking is not a reason to sell. Selling, for Fisher, was a decision based on facts about the business, never a decision based on fear in the moment. Section 6. The scuttlebutt method. How Fisher actually researched companies. Here's something most people have never heard of, and it might be the most practical idea in the entire book. Fisher didn't just read financial reports. He talked to people. He called competitors. He talked to former employees, suppliers, customers, anyone connected to a business, and quietly pieced together the real story of a company. What insiders actually believed, not just what the official report claimed. He called this the scuttlebutt method. Basically, gossip used wisely. The financial reports tell you what a company wants you to see. The people who work there, compete with it, or buy from it every day will often tell you the truth. You and I don't need to call up a company's competitors, but the lesson translates perfectly into everyday life. Don't just trust the shiny advertisement. Look at reviews. Ask people who've actually used the product. Look for the real story underneath the polished marketing. The official version of any story is rarely the complete one. So let's bring this all together. Philip Fisher's entire philosophy can be boiled down to a few simple beliefs. Buy a real business, not a stock price. Ask the right questions before you invest, about growth, about leadership, about honesty. Avoid the crowd, avoid the hype. Avoid checking your portfolio out of anxiety every single hour. Hold on with patience, the same patience you'd give a tree you planted, and intend to watch grow for years. And only sell when the facts about the business actually change. Never because you got scared for a day. This is not a get-rich-quick idea. It was never meant to be. Fisher's own biggest wins took years, sometimes decades, to fully show themselves. But that's exactly why it worked. Because almost nobody has the patience to follow through, which means almost nobody actually does this. You don't need to be a genius to use these ideas. You don't need a finance degree. And you definitely don't need to watch the stock market every 5 minutes. You simply need to slow down, ask better questions, and give your decisions time to prove themselves. If this helped you understand your money a little better, that was the entire goal. Take one idea from this video, just one, and actually use it the next time you think about where to put your money. Thanks for watching, and we'll see you in the next one.